Hope everyone can see it now.
It's coming up now, Neeraj. It's not visible now. Yes, it is. It is visible now. Go ahead.
Okay. Yeah. So quickly starting with the macroeconomics. So in terms of GDP growth rates, we are talking about 9.2% for this year and 8.5, around 8.5% for the next year. But the key factor here, which we need to understand, is whether India is catching up with the trend growth which it was on pre-COVID. And there looks like that. So if you look at the left-hand side chart, this dotted orange line shows you the trend growth for India prior to COVID shock when it hit us. And the red line is the actual numbers up to 2021, what has transpired and what we see going forward. So essentially, up to 2023 as well, we don't expect catch up to happen. So it may be a little longer. It will take a little longer for us to catch up, and then only maybe we can say that the recovery is complete. And therefore, whatever like economic shock India has experienced in the last 2 years, it may take another 3 years, 4 years for undoing it completely and catching up with where we were on the trend growth earlier. So that's one important point we need to remember. The other thing which, like in terms of the GDP growth rate, again, overall number maybe 9.2% for this year. But if we try to like go deeper and try to understand where this growth is coming from, then in real terms, what you see is that fixed capital, this is the capex part of the GDP, that is growing by around 2.6% between 2021, like for the last 2 years. This is the growth. And most of the growth here has been again supported by what the expenditure government has done on the capex side and all the subsidies, all the in a way schemes which the government rolled out in terms of taking care of poorer sections. That has grown by 10.7%. Now the unfortunate part here is that private consumption growth still is negative, and this is around -3%. Essentially, anyone who is on the retail side, who is selling say goods or services to consumers on the day-to-day basis, therefore they are not they haven't recovered, and their recovery is even slower, and therefore the numbers on the GDP side are trying to show us that as well. And as we know that the contact services are there, like tourism and all, and hotel industry is the one which is suffering a lot. Moving ahead. So this is on again the production side. Again, whatever the latest data is available with us in terms of September and November 2021, if you look at all the different key consumer sectors, the picture is very, very mixed. That other than maybe consumer non-durables and pharmaceuticals and rubber and plastics, which I think the growth is coming because of COVID event and whatever, like these industries needed to provide some goods and services. So those are gaining. But say beverages, leather products, consumer durables, motor vehicles, furniture, all of them are down. So essentially what the aggregate numbers are showing us, that story pans out when you look at all the major sectors of the economy in terms of goods. And therefore, maybe the growth recovery will be even slower for these sectors, given that the COVID shock still persists and the third wave, we are still experiencing that. And then again, we have talked about this K-shaped recovery where, because it's not the affluent section or the top 10%, the top 20% who are suffering, it's the bottom 50% or bottom 60% from where this consumption compression is coming. So maybe one hope was that will the government provide some kind of benefits, direct benefits on that side? Again, what has happened is that the government has chosen an indirect approach, and there are no direct measures on the boosting the consumption directly. So that's one point which we need to take away. Again, one very big story, the positive story for India, which has been there for the last 2 years, is our growth on exports front. Again, the number looks very big in terms of 25%. So we try to split this growth, or in a way, split this growth into three main components. How much of this growth is coming purely from increase in prices, because commodity prices are going up, people are increasing the prices. So how much of that is coming from that aspect? So out of the 25% growth, almost 13.5% is coming from that. So in terms of the real growth, it is around 11%. And there is a great story that only 0.3% is coming because international trade is increasing. And most of this growth is coming that India is gaining market share, or Indian companies are gaining market share from all the other companies which are existing in other countries. And so this can happen either for two reasons. One, either you are becoming more competitive, like we are becoming more competitive in comparison to them, or they are becoming uncompetitive, or they are not able to supply goods because of COVID shock or some other problem, supply chain bottleneck they are facing. So we need to see whether this trend continues going ahead as well or not. But this is something which is like a big positive for India going forward, and we need to see whether this trend continues or not. The other thing there is, again, because government is very, very keen that export market becomes big for us. So now one big announcement they have done, and again, we will need to see the details, is the whole revamp of this SEZ policy, combined with the Gati Shakti scheme and all the capex which the government has done, which I will talk about subsequently. Again, government is trying to take a long-term approach and see how we can fix all these issues in the long run. Going ahead. So this is another aspect which is important, and again, maybe this is on the say the bigger industry side, but still this is very, very important, because any investments, any capex done by them, in a way, has a downstream effect in terms of trickle-in effect as well on the MSME industry as well. And this was a story pre-COVID as well, that we used to call it a twin balance sheet problem, where there was corporate balance sheets were stressed both on the banking side and on the corporate side. And somewhere what has happened in like last 3-4 years is that this has gone through a massive deleveraging on the big corporate side, and now they have like better interest coverage ratios, better financials. And at the same time, what they have been able to do is that they have been able to move away from bank financing and go into other channels of financing, say like through bonds issuance or ECB and all. So therefore, the dependence of these companies on say the bank credit and at the same time deleveraging now puts them in a position where they can quickly start to do a lot of capex when they see a lot of demand on the other side. And that's what the government is banking on, that this year when COVID is not there, they will be able to do it. And even on the banking side, because the NPAs are not going to be, they are expecting that they will not increase by too much. So even the banks may be in the position to lend credit going forward. So therefore, government is expecting maybe in the H2 of financial year 23 that the capex will start picking up from the corporate side as well. Again, so one key driver of GDP growth in actually any developing economy, and we don't focus that much on this aspect, is real estate, and within that, residential real estate. And there again, our growth has been very, very tepid, and it has been very, very slow. And in a way, again, governments like state governments are also involved in terms of the stamp duties and everything. So they have tried to again take some measures, but we need to see whether like now, given like, and I will discuss this little later, that if interest rates again start rising, whether this recovery or cyclical growth which was there in the real estate sector can come back. Capex is fine, but what happens overall after taking into account all the other measures? And again, there what is happening is that central government is trying to take this proactive measures where they know that there are a lot of structural problems in this sector in terms of the control which the state governments have and whatever structural reforms they need to make. So what central government is doing with 1 lakh crore of capex loans, which central government is going to give to different states, this for 50-year interest-free loan, there one of the additional criteria for grants for them is that they need to revise building bylaws, they need to change town planning schemes, they need to think about how transportation is going to be built on those in those places. So again, central government is pushing the state governments to reform so that whatever structural problems the housing industry or the real estate market faces, those can be removed, and therefore there is some growth coming from that side. Now moving to government finances, and again, this is the most talked about point, that this capital expenditure, which is again why like we economists love to talk about it, is that this is a very high multiplier in terms of say 1 rupee spent by the government, it can lead to 1.5 rupees to 2 rupees or even 2.5 rupees increase in GDP, or impact can be that much. So therefore, what government has done is that they have gone ahead and announced a large increase in this capex. The problem always is whether the government will be able to spend this much money within 1 year, because as we all know that it takes a lot of time in terms of deciding on the projects which we need to like execute. Then maybe some kind of auction, then some kind of all the other after that, like it needs to be rolled out to some companies, and then they need to start building it out, and then disbursements need to start happening. So whether all this can be done in this 1 year, that always is a challenge. So therefore, what government is trying to do here is, central government is trying to do here is that because state governments are capital constraint or debt constraint, they can't take more debt. So what they are doing is that central government will take more money from the debt markets and give it to the state governments as interest-free loan, so that a lot of capex can be done at the state government level. So what essentially will happen is, and that's the catch, that to avoid double counting, either this will be go into state capex or this will count as a central capex. It can't be done in both places. Therefore, that needs to be kept in mind. But still, this seems to be the strategy, and this is what government is thinking, that when this fiscal policy comes in, it will crowd in a lot of private sector investments, and that should lead to like higher GDP growth going forward. On fiscal deficit, again, it's 6.4%. And there, what they have done is that, as you would see, that the fiscal deficit number is falling marginally only, and revenue expenditure, or I will talk about it a little later. So what they are doing is that the total expenditure they are keeping constant for themselves, and they are shifting it from revenue to capital, and that's how they are doing it. Moving ahead, so on the revenue expenditure side, what is happening there is that again we see and we saw this in the last slide, that this number is coming down for India. And again, like the very simple reason for that is the government had a lot of COVID relief measures, especially on the food subsidy side and fertilizer subsidy side, and even MG Narega. So now they are rolling back those measures. So whatever expenditure decrease that has happened from that side, a lot of it is going into paying the interest income or interest payout for all the debt which the government has issued in the past. Little bit of the money is going into PLI scheme. Some of it is going into this pipe water scheme which the government of India has, and then government of India has announced this digital initiative on education. So that's how they are doing it, and idea is again to shift the revenue expenditure to capital expenditure, and because that has a larger multiplier. On the taxation side for the government, again, the right way to look at it is always normalize to GDP rather than looking at absolute numbers, which may present a completely maybe sometimes incorrect picture. So that's what we have tried to do here. And what you will see is that the numbers in terms of say gross tax revenue to GDP ratio still below what there was in 1819. And in fact, in between there have been a lot of say changes on the direct tax side on the corporate taxation. But one thing which is very, very important, government is only expecting 10.7% increase in taxes in financial year 23 over the base of financial year 22, whereas GDP growth in nominal terms they are expecting 11%. And if you look at the nominal, if you look at the inflation numbers being projected by RBI, which are around 5%, and the growth rate of around 8.5%, which we are expecting in the next year. So 13.5%, 14% could have been the tax growth number easily. So government is being very, very conservative on whatever they are expecting in terms of the tax revenue collection. Most likely the number is going to be more. But I think the reason for this conservatism may be that they want to leave some room for themselves to cut excise duties and everything if oil prices remain very, very high, and whatever buffer needs to be provided by other tax revenue which government is collecting. Therefore, maybe that may be the motivation, but something which we need to understand going ahead. Moving on, On the direct tax revenue, again, I mentioned that this number fell both because of COVID and because of the new corporate tax rates, but now it is slowly started increasing. So we need to see how quickly it returned back to what tax to GDP, direct tax to GDP ratio was. And again, because government didn't announce any kind of other than cryptocurrency taxation, they didn't announce any kind of new taxes on corporate side or even the indirect on the personal income taxation. So we need to see how quickly it recovers, and that will require widening the tax base. On GST, I think the most important factor which we need to take away from this budget is again, we have been talking about this historic high numbers in terms of GST collections, but still in terms of if you normalize it by GDP, you see that still we have to hit the ratio like 80, we are below the 18-19 ratio. But the most important point here is that compensation cess is ending in this year in June 2022. 14% was guaranteed to the state government growth rates. Now, what will be the new pact between the state governments and the central government? We need to watch out for. And if there is some kind of continuity in terms of, say, this 14% growth rate, then GST rates or the compensation cess may need to go up. So that we need to be mindful of that. And on the other indirect tax revenues, which are essentially custom duties and excise duty, this has come down again, as I discussed earlier with you, because of the cut in excise duties, which government did last year as well. This year, actually, when oil prices were very, very high. So we need to be watchful of this going ahead. Moving on the financial markets and inflation. And again, this is inflation is one of the key factors, I think, which will decide how successful all the different measures which the government has taken this year's budget, whether they materialize on the ground or not. So what is happening here is that if you look at the wholesale price inflation, and if you look at for all commodities, this is around for last month, which we data December, this number is around 13.5%. So essentially, this is the price which the producers are facing in the wholesale market. So now, therefore, the cost is increasing for them, and they can do two things. Either they can absorb this cost, and that decreases their profitability, or they can pass it on to the consumers. If they do that, it will have two impacts. One, consumer price inflation, that will start going up. And second, maybe they experience some decrease in the sales which they are doing, and therefore, again, that has some revenue impact. In nutshell, what is going to happen is that in this first round, if the prices remain high and all the producers, all the companies start passing on these prices, that consumer price inflation is going to go up. And if consumer price inflation starts going up, then RBI has this as a target that they need to keep it below 6% and at 4% in fact on average, and between 2 and 6%, and they will start increasing the interest rates in the economy. And already there is a talk that they will try to do that. And if they do that, then if interest rates start going up, then the whole plan which the government has on the private capex side that will come back, how credible that will be in the increasing interest rates environment, that needs to be seen. So therefore, it is very, very important that the inflation is kept in check. But how do you do it other than like whatever supply side measures in the short term you can take? So this is something which we need to be mindful of going forward. And one additional factor here, which will again be very, very important, is what happens in the developed countries. Commodity prices are very, very high already, and there is some speculative demand. People are investors are investing, hoping that the prices will stay high or get even higher. But what do US Fed or European Central Bank does in terms of the interest rates? Because if they start increasing interest rates, then there will be there may be sudden flight of capital from India, whatever money FIIs have invested, and they have already withdrew some money in January already. And if that starts happening, then RBI will be under further pressure to increase the interest rates to keep the parity between the interest rates which are there in, say, developed countries and India. And that can have, say, another round of cost escalation for the corporate India, and therefore whatever the capex plans are there in the country. And therefore, that's what actually you see immediately, because the other thing is that monetary policy or any kind of fiscal policy has a lag of 6 months, 9 months, or even 1 year sometimes. But bond markets and stock markets react very, very quickly. As the budget was announced, with the 10-year government security yield, government bond yield increased by 20 basis points, 0.2 percentage point, it immediately jumped. So somewhere, what markets are trying to read is that interest rates are going to go up. RBI will have no choice but to increase the interest rates. And this is coming from multiple reasons. One, government will need to borrow a lot, and therefore the cost of borrowing for the government will need to go up, because foreign institutional investors may not be interested in investing in government securities in India, or if they do, they will ask for a higher yield. And on top of that, interest rates are going to rise in, say, US and Europe as well. So already that has started, and we need to be watchful of the next monetary policy statement of the RBI. Most likely they will increase the repo rate. So that's where things are heading. And maybe we have already hit the trough in terms of the interest rate cycle in the country. On exchange rate side, again, as I mentioned, that when there are capital outflows, then your rupee will also start depreciating, and that's one more reason for RBI to intervene and increase the interest rate. But now they have been able to keep the US dollar INR exchange rate or even euro exchange rate in check. But we need to be watchful of this trend as well going ahead. Another maybe 3-4 minutes, then I end. On the sectoral announcements, again, on the MSME sector, and somewhere, so this is the other trend which the government has, that they don't wait for maybe say the budget only to announce many of the measures which they need to do. So therefore, they have already a lot of action has happened on MSME sector already, and I think all of you know that. Say in terms of changing the definition and in between as well when COVID was there. So what they have gone ahead with is some kind of continuity here. And so one key focus area for them, again, credit guarantee is there, and there as well, the focus is on the hospitality sector or tourism sector, but they expanded the credit there as well. Again, they have this ramp scheme, now where they want to, in a way, help MSME industry, in a way, whatever challenges they face in terms of scaling up. So they want to help them in doing that. And third thing they are trying to do is that whatever digital solutions can be used to expand or provide services from the government side. So they are trying to do that, and therefore they are using digital portals going ahead more and more. So this time now they are thinking of integrating all these different digital portals, which are in a way helpful for MSMEs. And this last thing is this bank guarantee thing, or this Shortity Bonds. So essentially, this has been bane for anyone who works with the government, all these bank guarantees. And right now, this market was constrained in terms of only banks providing these bank guarantees. So now what the government has done is that they have, in a way, introduced this concept of Shortity Bonds, where even the insurance, you can say a MSME or anyone who needs a bank guarantee can also give Shortity Bonds, and therefore competition increases on the supply side. And somewhere hope is that interest rates charged or whatever cost for doing these things reduces for whosoever is doing these things. So these are some of the measures which the government has taken, maybe in terms of the structural part of the policy side. I'm sure on the direct taxation side and indirect taxation side, my colleagues will talk about these measures further with respect to MSMEs. Going ahead, and this is on infrastructure. There again, up to now, or maybe up to last year, the focus always has been, and again, as I was discussing earlier, the focus always has been on how much government is spending on infrastructure. But now the question is evolving there, and the question is not limited to how much the government is spending. Now the question is how quickly they can spend, and at the same time, once they have spent it, how quickly the results will start coming in. And therefore, the focus is shifting along with spending is on coordination. It shouldn't happen that the road is coming and the airport is delayed, or the airport has come and the road is delayed, or railway network is not there, or warehouse hasn't been set up near an airport or a railway station. So now what the government is saying is that we need to focus on all these things. And so therefore, they are trying to create a mechanism within the government where the expenditure, which at least the government is doing, can be coordinated across different logistics sectors or transportation sectors. And key idea here is to reduce the transportation costs in the economy internally as well as on the port side, so that again we keep hearing this number, the 8 to 10% is the cost of logistics as percentage of GDP. They want to bring it to 5%, and their idea is that once you do that, then you immediately see that your exports are becoming competitive and your MSMEs are becoming competitive, or all your small industries or new sectors are becoming competitive. So that's the idea which they are working on there. Moving ahead, climate change and clean energy is like a big focus area, and we have like mentioned all the key announcements on this. But two or three big ones are maybe this PLI scheme, which is come on solar, like expansion of the PLI scheme on the solar power panel side. Then battery swapping technology is very important, especially in the urban areas, because you don't have much space to create like energy charging, charging stations and all for EVs and everything, and you need very quickly to have interoperability. And given that government has, I think if you look at this way, government has already decided that climate change and clean energy, along with digital or hardware, are going to be the two focus areas for them in next 10 years. So whatever is the requirement there, they are going ahead and doing those measures. And therefore, last discussing this digital economy and sunrise industry, and they have already announced PLI schemes on many of these, like white goods, mobile phones, televisions, and all. And now, chip manufacturing is something which they had already announced 2 months back, and now 5G technology or 5G manufacturing is something new PLI they have announced. And their idea there is that it needs to be indigenized. Maybe it can't be done with 5G, but when 6G comes, India should have its own standards, its own equipment, and Indian companies are supplying that. And one more area where within digital technology they want to like build early lead on is drones, and therefore they have announced this Drone Shakti, which is essentially like if some company or industry wants to provide drones as a service, then they can do that, and the government is going to help them. So these are some of the key focus areas in terms of the sector, major sectors for the government going ahead. With that, I will stop, and if you have any questions, I can take them.
Perfect. Thanks, Neeraj. I think if there are any queries, I think we'll have that sent separately. I would now want to call Anmol to take up the direct tax part. Anmol, over to you.
Thanks, Sonal. Sonal, is my screen visible? I just started sharing my screen.
Yeah, Anmol.
Okay. So I'll start with the first good proposal. There was a deadline for the new manufacturing companies to be set up in India, wherein a lower tax rate of 17% was available. And now they have extended the deadline from 31st March 23 to 31st March 24. So anybody who's planning to have some operations started in manufacturing sector, they can just set up a new company instead of opening up an additional plant, and can avail the low tax rate of 15% as against the currently available rates of 25 or 30%. So this is a very welcome amendment. And given the COVID times, it was quite expected that there would be delays in starting the manufacturing processes, and thus the government has considered the request of the Indian taxpayers. So next one is a bit unique amendment, which was brought in to overturn the Supreme Court judgment, wherein the Supreme Court had held that if you convert an outstanding interest amount into a debenture, you have in effect paid the amount of interest, and thus you are liable to claim the deduction under Section 43B. Now, to overrule that judgment, the government has brought a specific amendment wherein they have said that if you convert the interest component of a loan into a debenture or any other instrument, then that would not be termed as payment of liability. This is specifically done to overturn that Supreme Court judgment. Moving on, this would be a very important amendment for the SME sector. Previously, all the benefits or perquisites which we were giving to the persons engaged in the business profession. An example, you are just selling goods to the ultimate customers via distributors, and you give some target-based incentives to the distributors that if you achieve this much target, we'll give you this item, or we'll give you a free holiday somewhere, or you will be entitled to a lucky draw, etc. Now the government is saying that, okay, there's no tedious provision on such incentives. So they have put in a obligation on the companies who are making the payment that when they make the payment, they'll have to do a TDS if the benefit exceeds INR 20,000. The amendment date is a bit of controversy because, somewhere in the documents, it has been mentioned that it is effective from 1st April, but somewhere it's mentioned as 1st July. Our reading suggests that it should be applicable from 1st July 2022.
Anmol ji, you are not audible.
Sonal, I think he has lost the internet or what?
Anmol, you are not audible.
सोनल कुमारला फोन करून सांग ना.
Let me call Anmol. Just give me a second.
Yeah.
So there is some internet issue. Anmol is just connecting.
Right again. Sonal, am I audible now? Okay.
Yeah, Anmol, you're
Sorry,
audible.
sorry, I think there was some internet issue. I'll just share the screen again. Is the screen visible now?
Yeah, go ahead.
Sorry. So I was on the updated return of income. So the government is saying that, okay, you can update your return you can pay us some extra tax and we will accept it. So, in the current law, there was no possibility of a settlement commission now because it got abolished last year. So I think they're giving an opportunity to the taxpayers that, okay, you can update your return and offer some additional income, but you will be paying us an extra amount also. Then this one is a very relevant amendment and important for SME sector also. And, we'll have to be more cautious when we are making any payment, which is, prohibited under any other law. A common example which was referred to in the budget documents was with respect to the freebies which were given to the medical practitioners. So, if under the SME laws, there is a prohibition that, you cannot make such kind of a commissions or some grants or some kickbacks to someone else, then that payment, if made by the company, will be disallowed under Section 37 because of this amendment. Then there is an important amendment, the cash credits. And I think SMEs would have to be very careful with this one. If there is any loan or borrowing which is coming in your balance sheet, then now the onus is on the taxpayer to explain the source of that loan also. So till now, if we used to submit the PAN, the ITR, or some other details of the lender, the matter would have been closed at that level itself. Now, because of this amendment, the onus is on the borrower to explain from where did the lender get the funds also. So it's a very difficult task for the person to explain this. So it will have to be seen how the judiciary reacts on this amendment, because we would not be totally aware of the the affairs of the lender, but such is the amendment now. Now, next one is something to reduce the appeals filed by Revenue Department on regular matters. So what the government is saying that in case if you in your own case there is a matter which is pending at Supreme Court or High Court level, similar matter is pending in some other assessee's case also, then the revenue can file an application that, okay, till the time the ultimate certainty is not received, then the department will not file an appeal. So this is a welcome amendment, so as to just reduce the number of years the litigation keeps building upon. Next one is an important amendment for all the current audiences who have tried to claim the deduction of education cess basis some favorable judgments. So there were some favorable judgments of the High Court that education cess is not in the nature of tax, and thus you can claim a deduction of the same. But the government is saying that this was never the legislative intent. It was very clear that cess is not considered to be an allowable expenditure. And now they brought in a retrospective amendment to say that you will not be allowed any deduction of any surcharge or cess. They are to be seen as tax only. Now the next amendment is under Section 14A. There were some favorable case laws wherein it was held that if you don't have any exempt income, then even 14A doesn't come into picture. But the government is saying that is not the intent, because you may be doing some expenditure and though income may be coming in some different years. So the government has said now that 14A will still continue to apply even if you have not earned any exempt income, but you are still doing some expenditure in relation to that. So this was just brought in to overrule some High Court and special bench judgments. And anybody who has taken the argument that, okay, I did not have any exempt income, will have to just think of some other arguments now. So Goodwill, there's an amendment in the Goodwill related section. Previously, they just referred that the depreciation on Goodwill not be allowed going forward, and they said that you have to reduce it from the block. Now they have brought in amendment to say that when you reduce it from the block, it will be considered to be capital gains. So there was a rule which was brought in, Rule 8AC. So you'll have to consider the rule and accordingly determine if there is any capital gain coming in your hands or not. So this is a very specific amendment for those who were claiming a depreciation on goodwill. So Tds and Tcs provisions, they have been troubling us for quite some time now, because the quantum is not huge and the processes are cumbersome, and it's like 0.1% only. Now what they've said is that last year they have brought a utility that you can just put the PAN and check whether the person has filed his return of income for the last 2 years or not. Now that last 2 years has been amended to 1 year. Now they're saying that, okay, if you are making payment to someone And 1 year before that year, if he has not filed the return, then we'll impose a higher TDS rate. So I think they're trying to make it more stringent for everyone to file the returns. Then
Sir, again you are not audible. Anmolji, you are not audible.
Yeah, I just call him. Just give a second.
okay, give it a try now. Sonal, can you hear me now?
Yeah.
Okay. Sorry, I'll just keep my video off. I think there's some bandwidth issues, I guess. So the next amendment is in relation to the assessment on the predecessor entity. So there used to be mergers which were predated. So if today a merger is happening, it is applicable from 1st April 20. So the government has said that the officer used to send notice on the defunct entities where the merger used to happen. So they saying that we will take hold of the successor entity. We'll do all the assessments on the successor entity. And the successor entity would be obligated to file the return of the pre-period also from when the amendment is effective. Then reassessment provisions, this is a very important one. Last year, the government said that, okay, we'll restrict the time limit to 3 years. And in very special cases, we'll extend it to 10 years only. Now they have made few amendments in this section and the scope has widened a quite. So now they're saying that in addition to in the form of an asset, even if we find that you had some undisclosed income, which you have already spent on some expenditure, we'll even cover those cases in the 10-year limit. So imagine a case, somebody had an undisclosed income and he spent that money on his marriage or some other affairs. Then also that matter can be reopened in the 10-year window now. But this was not a possibility in the previously worded provisions. So they have widened up the scope for the reassessment proceedings. Now for the individual tax proposals, the public was expecting that there would be some increase in the standard deductions or there would be some relief in terms of some COVID related deductions, but the government has not brought in. Though the FM started the speech with thanking the entire nation in the deposit of taxes, but no relief for the salaried or individual taxpayers. They've done some good amendments in terms of capping the rate of surcharge at 15% so that it's uniform for everyone. And COVID related measures, they had issued some press releases in the past saying that if you receive some amount for medical treatment or on account of death, that will not be taxable. They have just codified that law now. They brought in a specific provision for that. Regarding the virtual digital assets, they have now brought in some clarity, though the FM is saying again and again that what clarity have brought in the tax law does not legalize these currencies, and they want to tax it at the rate of 30%, which is the highest rate between the sale and the cost. And the TDS rate would be 1% for the person who is purchasing it from the seller. So that's all from the tax front. And if there were any questions, we can take it at the end of the question panel. I hope I was audible, and I apologize for the network issues because I think there was some network related issues at the end. So over to you, Sonal and team.
Sonal, are you there?
Yeah, so thanks, Anmol. Sonal, you're not audible, but now we are coming to the indirect tax proposals.
Okay, go ahead, please.
Yeah. So basically, at the outset, before I start my presentation, I would like to thank Mr. Saluk and the entire team of SME Chamber of Commerce for arranging this wonderful session. With respect to the amendments in GST, if you see, or in customs, if you see, the finance minister has unveiled this budget in budget finance bill 2022 in the midst of the Omicron wave. So therefore, there was no major tax amendment as such in the first year of the Amrit Kal, which has been given a name by our finance minister as well as our Prime Minister Mr. Modi. This is being an Amrit Kal in first year of the Amrit Kal. The amendments are more towards clarificatory in nature and towards the ban under the banner of Make in India and Atmanirbhar Bharat, which means that there is more benefit being given to Indian production houses, and thereby more preference would be given to SME companies, small companies, so that India can be considered to be the production house and do more exports, and there would be a lesser imports going forward. In this background, let me take up with the customs amendment first. I am audible, right?
Yes, you're audible.
Yeah, thank you. So, if you see the custom amendments, there have been a lot of duty rate changes, which the finance minister has, talked about, that there would be around 350 notifications providing the exemptions which will be phased out. And if you see, majorly the exemptions being given to the raw material, if we see, and the finished good which we are importing from outside India has been now more costlier. So if you see, majorly what will happen is that the raw material will be cheaper when it would be bought in India, whereas if you are bringing the this capital good, or you are bringing the finished good, it would be costlier. Therefore, there would be more opportunities for small manufacturing houses or for big manufacturing houses to do more manufacturing in India, and that is what the intent of the government as well in the Make in India concept. Along with that, if you see, government has also increased the duty rates. They have been talking about increasing the duty rates on the capital good. Earlier, the notion was that the capital goods or the technology is to be imported from outside India, like Germany, Korea, etc. But now, realizing that we also have that capability of manufacturing the capital goods within India itself, and government wanted to have a level playing field for the Indian manufacturers, also those who are manufacturing the capital good. Therefore, the government is talking about removing the project import concept, which is wherein the duty rate for importing of capital good is as low as 1.5% or 2%, and which would be at a normal or a moderate rate going forward, which would be 7.5%. Along with that, government has also rationalized the exemptions with respect to social welfare cess. So there have been a lot of ambiguity that on which products the social welfare cess will be applicable, and what would be in case the basic custom duty on the product is nil. So government has also clarified that with the separate schedule, in which the government has specifically talked about that on which all product the social welfare cess which will be applicable. So this, if you see the entire amendments which government has made in this current finance bill in relation to duties, are essentially with respect to Make in India, which We believe that will give a lot of boost to the Indian manufacturing industries, specifically not only to the big business houses but also to the small manufacturers or the SME sector. So this is a welcome move with respect to the rates, and considering that there would be minimal ambiguity going forward with respect to the custom duty rates. Now moving on to the adjudication part of the customs. Now again, it is much awaited clarificatory amendments which government has brought into the law so that there would be a minimal litigation cost in the country, which again will help the SME sector specifically, because if you see the big business houses definitely have the big consultants, and they have a sorted and very formal channel of communication with the authorities. The struggler with respect to the ambiguity in the law are generally the SME sectors. So, to looking at that, the government has come up with the clarificatory amendment with respect to adjudication also. There was an ambiguity that whether the DRI would be able to issue us a show cause notice or not, and there is a Supreme Court judgment in case of Canon India wherein it has been held that there is no power with the authorities of DRI, which is Department of Revenue Intelligence, to issue the show cause notice. That has been done away with. The government has been given the power to the DRI officers also to issue us a show cause notice, which is a long awaited clarificatory amendment. Other than that, generally we have seen that whenever there is an investigation, audit, or the proceedings like reassessment happens, so it has been done by the investigating authorities. However, as a matter of fact, we have been taking this up with the authorities that it should be with the original jurisdiction authorities. Now which has been clarified in the law itself. So again, this will help the companies, those who are into the litigation or in investigation, that the uh, original jurisdiction authorities would be doing their reassessment adjudication. Again, we have seen in the past there is a frequent change in the law, and wherever the advanced ruling has been obtained, the government is saying, and there is a law as well, that we have to abide by that advanced ruling. So therefore, in this line, the government has come up with the amendment saying that all the advanced ruling which has been procured would be valid only for 3 years, given the fact that there is a frequent change in the law. The advanced ruling which have been taken prior to Finance Bill 2022 would be applicable for the 3 years from the date when this finance bill will get the presidential assent. Other than that, there is also a clarificatory amendment, or for in the sense of ease of doing business, there is an import of goods at a concession rate of duty rules which are there, under which the SAC is able to import the goods at the concessional rate of duty. However, there are some specified goods which can only be imported with some specific rules and regulation to be followed. Of late we have seen that there are a lot of misusage which has happened with respect to these type of ICGR rules. Therefore, government has come up with a proposal of digitalizing this rules as well, wherein whatever we would be importing, we have to import with the IAN, which is import identification number. So while these rules have not been much used till now, but I think after this digitalization process, there would be a much more frequent import under this rules at a concessional rate of duty for the products which would going to be imported. So again, this is a good move for small scale industries, those who would be able to use these rules for importing the goods into India for manufacturing it further. Next slide, Karthik. Yeah. So this is about the customs broadly. Now moving on to the GST proposals. So in GST proposals also, as I mentioned, that government is looking towards ease of doing business. Again, when I say ease of doing business, it also means that since the big business houses have their own channelized approach towards the authorities through the bigger consultants, the small companies are always been left out. So it is important that the law should have the clarity so that the small business houses can also get the credits. And we have seen of late that there is a lot of issue from the authorities in relation to input tax credit. So government has come up with a lot of amendments in the input tax credit. So taking some specific amendments which have been brought into the Finance Bill 2022 by Madam is as under. So first of all, they have realigned the ITC provisions with respect to GSTR 2B. So earlier we have been taking the credit in basis the GSTR 2A, basis which what was happening is that GSTR 2A is dynamic in nature. So suppose somebody files his return, GSTR 2A auto populate and get amended as and when the returns are being filed by the vendors. However, GSTR 2B is specific. Further, government is not able to have this two-way communication till now. So government has done away with this two-way communication rule, thereby deleting or phasing out the provisions of section 42 and 43 of the CGST Act. And now the government is saying that the G 2A is to be the credit is to be availed on the basis of GSTR 2B. Further, government has also talked about in the finance bill for a restriction on availing the input tax credit. So initially the problem was that if I being a customer, my vendor has not filed the return, I being penalized because I will not be able to get the credit, though the vendor would have charged the entire amount and I would have paid the entire tax to the vendor. Looking into it, and there are a lot of representation which have been made both by the small scale industries as well as the large business houses, along with many of the chamber of commerces. So government has come up with some of the restrictions for the availment of the credit as well in the current finance bill. So first of all, now what the government is talking about, that the default in making the payment of tax by the vendor will not be able to take the credit, means utilize that credit for payment of the taxes. Also, if there is a difference in GSTR 1 and GSTR 3B, so GSTR 1 is where we report our output tax liability, GSTR 3B is where we pay our output tax liability. So we have seen that our vendors are not filing their GSTR 3B, thereby they are just showing in GSTR 1 that they have declared their output liability, but they are not paying through 3B, because of which the customer who is purchasing the goods from them is facing the challenges. So the government is talking about the restriction of availment of the credit for these type of vendors as well, those who are filing their 1 and 3B, wherein there is a difference in 1 and 3B. Also, there is availment of excess ITC by the vendor. There has to be a limit which will be prescribed. Newly registered vendor will not be able to take the credit to some extent, or there would be a class of vendor which would be prescribed for which the restriction will be issued. So earlier there was no such restrictions which were there, but of late the government has also realized that the vendor is doing a default because of which the customer is not able to get the credit. So now the government is talking about putting some restrictions on those vendors also, in case those who are the non-compliant vendors. Other than that, some ITC related amendment with respect to, this is again a welcome move, wherein generally our audit get finalized in the month of September of the following financial year or on October. So earlier there was a provision wherein we can take the credit only till 30th of September, means the return to be filed in the month of October, for the month, the September return to be filed by the month of October, 20th of October, we have to avail whatever credit is there for the previous financial year. That limit has now been increased to 30th of November. So there have been a lot of, again, the representation which have been gone to the authority saying that it should be increased to 30th of November, because till that time only we are able to get, our things audited, and we can, do the reconciliation, etc. So this is a welcome move. The government is talking about that in case the credit which is strongly availed and not utilized, on that there would be no interest. So this is again a amendment which will help the small scale industries companies, wherein they would have availed the credit, but which in case that has not been utilized, so there would be no interest liability on it. So we have been, talking to the authorities a lot of time that in case we have availed the credit wrongly but not has been utilized, so the interest should not be levied. So this is what has been clarified from a retrospective effect. Other legislative changes with respect to filing of the returns are that we have seen SSEs or the vendors filing GSTR1 just to claim the credit, but 3B is not been filed. In the process of ease of doing business for the SSEs, now the government is saying that somebody who's not filing his has filed his one, not filed his 3B, will not be able to file this one again in the next month. So it would be sequential. Earlier, the sequence was that GSTR 1 of April has to be filed, then GSTR 1 of May can be filed only if the GSTR 1 of April has been filed. Now, GSTR 1 of May can be filed only if GSTR 1 and 3B both of the month of April would be filed. So now it will be sequential. So again, this will help the small scale industries, those who are not having that much connect with the vendors to see whether they have filed their returns or not. Otherwise, their vendor will not be able to file the return. Also, the government has come up with new amendment when they are saying that consecutively, in case for 2 months somebody has not filed this return, his registration will get cancelled. Earlier this period was 6 months, so of late the government has realized that 6 months is too long.
Sonal, we have lost him or what happened? Why he left?
उनका कनेक्शन लॉस्ट हो गया सर.
Mhm.
I'll just call Pankaj. I think it's
Yeah, I think the connection is lost. I will check.
Am I audible now?
Yes, Pankaj, go ahead.
Sorry, there was a connection error. So basically, I was saying that government has come up with this amendment wherein they are saying that in case somebody is not been able to file the return in 1 month and he's
I think we are lost again.
yeah, am I audible?
Go ahead, go ahead.
Yeah. So again, also government has come up with the late fees for filing of the GST TCS return. There is also a relaxation which has been provided. As I told you in the last slide, that the government has now come up with the relaxation of taking the credit of the following year till 30th of November instead of September. In the same line, government has come up with the relaxation of time limit for issuance of the credit notes and the rectification of errors or omissions in the returns till 30th of November instead of September. So again, this is a welcome move, and always it is beneficial for the small scale industries and small business houses that they generally need time for doing such type of amendments. Also, in case we have paid the excess tax in the cash ledger, so we have to claim for the refund. But now the government has come up with the new amendment wherein they are saying that in case you have paid the excess tax in the cash ledger, the same can be transferred to the different state. So suppose if I have registration in 3 states, Delhi, UP and Maharashtra. So in case I have paid the excess tax in Maharashtra registration, that excess cash which has been paid in cash ledger can be transferred to Delhi or to Maharashtra, Delhi or to UP, but that would be only CGST or IGST paid in cash in the same PAN number. Next slide, Karthik. Again, with respect to GST refunds, so just to ease out the provisions of the refund, there is an ambiguity wherein government is rejecting the refund on the account that what would be the relevant date from which the refund has to be filed for the SEC supplies. So now it has been clarified that it would be from the due date of a monthly tax payment return, which is 3B, for filing of the refund, and the refund period is 2 years, which is already there. So now you can file your refund claim within 2 years from the date of filing of the 3B in case of SEC supplies. Again, this is a amendment which has come, which is more so, a specific clarification amendment. Alcohol industry is very important for all the states. Earlier, there was an ambiguity that alcohol liquor licenses, which are applicable to excise duty laws of the states, are liable to GST as well. But now there was a notification in September 2019. Now this amendment has brought into the law from retrospective effect, wherein grant of alcoholic liquor license will not be liable to GST. It is neither a supply of good nor a supply of services. It would only be liable to state excise duties. Again, if you see with respect to SEZ Act being replaced with the new legislation has been announced by Madam in the budget to enable the state to become the partner in the development of the enterprises and the service hub. Though the specific part or a procedural part of this has yet to be come out. However, if you see with respect to SEZs, lot of exports were there, and there are a lot of companies those who are coming into an SEZs. But after the income tax benefit being going out, the SEZ has lost its charm. But I think with respect to this amendment, definitely government is coming up to revamp the entire SEZ provisions, and we can see the special economic zones will be developed with the help of the respective states, wherein the states will also shed some of their revenue to provide the benefit to the specific companies, those who would be establishing their units in the special economic zone, which will again help in more and more production and export from India to the other countries outside India. Yeah. So this is all from indirect tax side broadly. So we are, I think, open to the questions now. Uh,
Okay. Anyone is going to speak again? Sonal, are you there?
so I cannot see Sonal right now.
Okay.
Sonal is there, but I think Karthik, we are done, right?
Okay. Thank you very much for sharing your thoughts on the particularly information we can say related to this budget. Friends, we are aware that this budget is a unique budget, particularly for the making India as a digital India, and especially for the supporting the Indian industries and SMEs to grow more economical. The project we have decided, or the dream project seen by our Honorable Prime Minister. And I'm sure that, with this budget, definitely industry will grow more, SME sector will grow more, and they will put efforts for the, achieve the target growth. Particularly if we look at the benefit of the SME sector or startups or manufacturing industry, I'm sure that this is one of the unique budget and very different budget we can say. But nevertheless, looking at the current 5 states elections, so government brought a very unique and very beneficial budget. But now we have to look at the how this implementation will be done. So because making budget, preparing budget is the most important, but implementation is most important. How the departments, how the agencies or ministries will put efforts to organize the activities, to provide the value addition services, provide a support to the concerned industry to get advantage or take advantage. I think SME sector will be definitely, you know, taking advantage, and it will take advantage also. And we will definitely support them to, how to avail the support services, how to take advantage of the incentives and schemes announced in this budget. somehow, most of the SMEs in India, they are facing a lot problem to understand the specific advantages of this budget. So what we are going to do, as I discussed with Sonal, so EY can help us to creating one document, a document which will focus particularly what are the advantages, benefits made available in this budget for manufacturing industry, exporters, and SMEs and startups, so that they will understand properly this document, then how to take the advantages of this particular budget, what kind of production link the advantages made by available, and how this can be a very crucial for them to take advantage during this pandemic, because literally 2 years SME sector and manufacturing industry face a lot problem. So as a some other way around a note, I can say the SME sector and manufacturing industry is trying to find a pursuit of the happiness from this budget 2022. So we have to see what are the happiness made available by the Honorable Finance Minister, and how the happiness will be made continue or particularly benefit of SME sector and manufacturing industry in coming 13 months. So therefore, let us take a pause here. Let us understand the uniqueness of this budget, and I'm sure that the participants, those will be listening over this webinar or the information after this webinar. I think most of the SMEs will be having question, what is my benefit, what is my advantage? So I request all the participants and delegates and members of the chamber to share your points, share your ideas, or share your questions so that we can reply you. So I request the EY team, let us have a one document particularly for the SME sector, advantage and impact on the SME sector, so that they will get a more idea. Sonal, over to you.
Absolutely. I think we can definitely compile that and it'll be a lot.
Can you speak loudly?
Yeah. Is it audible now?
Speak loudly, please.
Sure. No, so I think thank you so much, Salukesa. I think we will definitely be able to help you out with the document. We have something which is being made readily available. We'll definitely share that with the team, and any specific queries, we'll be happy to look at that. I think we have a good team of experts, both direct and the indirect side, from a taxation perspective. I'm already working with a lot of clients of all size, very cost-effective solutions that we have been able to provide our taxation. Also, the new age solutions is kind of the key today. The kind of savings that has happened, due to these new age technology which has been used. It is some of these projects are actually self-funding, for even mid-sized clients. So I think that's something which is for the companies to be open, and I think whatever the issues are, please feel free to have a discussion. We can use the chamber route as well, Salukesa and Maheshi, for routing us this, and we'll be happy to kind of assist in whatever way that we can. Salukesa.
Yeah.
Are there any questions, Maheshi? We have the team to take up.
I said thank you very much for sharing the information, and let us have a further one round again discussion on this, and I look forward to receive a document from you to circulate amongst the members, and we will circulate this link so that they can understand properly. Okay. So
Sure,
thank you, EY team, Pankaj, Anmol, and Karthik, as well as Meenal. Special thanks to Sonal for organizing this webinar. But let us see and let us work again on the specific sector. Thank you very much. Thank you.
So thank you so much.
Thank you.
Thank you.
Thank you.